Good morning everyone and welcome to my channel. Today we are diving into the topic of business valuation. Here is what we will look at today. The cost of debt, calculating enterprise value and pre-money valuation, other valuation methods. As always, all of this after our intro. And now the cost of debt. In the case of startups, calculating the cost of debt is not always simple. Startups often do not yet have stable banking relationships or consolidate access to credit. Thus, the actual rate they face to obtain financing is not easily observable. For this reason, the cost of debt is estimated indirectly through an approach that combines various risk parameters. Calculation method is based on three main components. The risk-free rate, already used before for the cost of equity. The risk-free rate is the return that investors expect from a risk-free investment, such as 10 years German or American bonds. Then the default spread. To account for the risk associated with the startup and the industries it operates in, I add a corporate risk spread. This spread reflects the standard deviation of stock return in the industry in which the startup operates. And the last is the country risk premium. So due to the specific risk associated with the country in which company operates, a country risk premium is added. By adding these three components, we can calculate the cost of debt. That is the last of the elements that we are missing to have our weighted average cost of capital. This indirect approach, which considers the startup's specific risk, is crucial for having a realistic estimate of the cost of debt. With this methodology, we can customize the risk assessment, adapting it to the specific context, enterprise value and pre-money valuation. Now that we have defined all the necessary parameters, we can move on to the crucial part, the calculation of the net present value, which is the area heart of the company valuation. To do this, of course, we need the cost of equity, cost of risk capital that we calculate, which reflects the return that investors expect to get in exchange for the risk of investing in the startup, cost of debt, which is being estimated using an indirect approach, taking into account the country risk, specific business risk, and the risk-free rate. And, of course, future cash flows. An estimate of the cash flows that the company will generate in the coming years, which are the main inputs for the calculation of our net present value. Having this information, we can discount future cash flows using the weighted average cost of capital as the discount rate. Just a few words about the terminal or perpetual value. Future cash flows are composed of an explicit horizon, typically 5 years, and an implicit horizon of terminal value, which represents the value of the company beyond the explicit forecast period. The terminal value is essentially the value that a startup or company will have when the initial growth period stabilizes. Since we cannot accurately predict cash flow for an infinite number of years, it is assumed that after a certain period, the company will grow at a constant rate. In other words, terminal value reflects the perpetual income that the company will generate, considering the fact that it will continue to operate and generate revenue, but with more modest and stable growth. If you want to know how we calculate the perpetual growth coefficient, let us know in the comments. I will just give you a preview. Most of the coefficients that you see in company valuation are unrealistically high, the illiquidity discount. When it comes to startups or unlisted small and medium enterprises, there is another factor that must be considered in the valuation, the liquidity. In other words, the difficulty of quickly selling or transferring a company shareholding. This is crucial when estimating the value of a startup. So, what is illiquidity? Illiquidity refers to the fact that, unlike a public traded company, a startup or a small medium enterprise doesn't have an easily accessible market where investors can buy or sell shares at any time. If you are the owners or shareholders, to sell your stake in a startup, it may take a lot of time and effort to find a buyer. So, why is the liquidity discount important? Since the investor cannot easily monetize their stake, the value of the startup must be discounted to reflect this difficulty. In other words, illiquidity increases the risk for investors who require compensation for this additional risk. Thus, the liquidity discount diminishes the company's value because investors may face difficulties in selling their stake in the future. So, the longer it takes to find a buyer, the greater the perceived risk will be. So how is the liquidity discount applied? The liquidity discount is applied to the enterprise value of final valuation and is usually between 20 and 30% depending on the level of liquidity perceived. So startups, which are growth stage businesses without a clear exit strategy, are subject to larger discounts than smaller, more established companies, which may have access to easier sales or merger channels. So illiquidity discount and discounted cash flow method. In the DCF method, after calculating the present value, future cash flows, and terminal value, we can apply an illiquidity discount to the bottom result. This discount is an additional factor that takes into account the difficulty of liquidating the investment and therefore reduces the overall value of the company. For example, if the total value calculated with the discounted cash flow for a startup is $10 million and we apply a 25% illiquidity discount, the final value of the startup will be $7.5 million. Calculating the equity value. Now we calculate the enterprise value of the startup, which represents the overall value of the company, including both debt and equity. However, in the context of capital increase, where the investors acquires a share of equity, we must determine the equity value, the value of the part of the company that belongs to the shareholders. In the traditional way, some might think of subtracting the value of current debt from enterprise value to obtain the equity value. However, to me, this approach is not correct when assuming a variable financial structure, as in our case. That's because in our methodology we assume a constant financial structure with a debt-to-equity ratio given by the capital structure of the startup, or, if missing, the average debt-to-equity ratio, the sector in which it operates. In the discounted cash flow context, as the overall value of the enterprise increases, debt and equity are also redistributed proportionally. Therefore, it is not correct to merely subtract the value of debt at the valuation time from the enterprise value to calculate the equity, because this approach assumes a fixed debt to equity in absolute value, which is not consistent with the dynamic approach we have adopted. The equity value we have just calculated represents the value of the company's equity before the capital injection by the investor. In practical terms, this value is the pre-money valuation. The pre-money valuation is the value of the company's equity without considering new funds that the investor will bring. So it is the value that the company has before the capital increase. This value is critical in determining how much of the company the investor will acquire in exchange for the capital they are about to invest. Other methods. When it comes to evaluating startups, you often encounter methods that, unfortunately, are inadequate or even wrong for the specific context. The most common methods that are applied for the evaluation of startups are the market multiple method. This method is based on the calculation of market multiples, such as the multiple of turnover or the EBITDA of similar companies in the startup sector. The idea is to apply the industry average multiple to the startup's revenue or earnings to get an estimate of its value. But main flaw: inapplicability to startups. Startups are early-stage businesses and their growth potential is not reflected in multiples of already established companies. These methods maybe work well for mature companies, but fail to capture the growth, momentum, and uncertainties typical of startups. There is no consideration for qualitative factors which are critical for a startup. Again, the venture capital method. This method is an approach that seeks to determine the future value of a startup at the time of an eventual exit, such as an acquisition or an IPO. The final value of the company is estimated starting from an exit multiple and discounted to determine the present value. Main flaws: dependence on exit projection. This method relies heavily on estimates of the future value exited, which are extremely difficult to predict. Market conditions and exit strategies can change dramatically over time. Again, it's oversimple. It doesn't consider startup-specific details, such as operational risk, business model inequivalency, or the development stage. It focuses too much on the end result and not enough on the growth process. Again, we have online methods. There are many online resources that offer quick but inaccurate assessment methods. For example, some automatic calculators or approaches based on the average of 5-6 different methodologies, often, or always, not consistent with each other, are used to arrive at a final evaluation. This approach is dangerous because averaging wrong values never leads to a correct value. And of course, an inaccurate estimate can lead to poor investment decisions, hurting the business owner and investors. In this analysis, we have seen how the discounted cash flow method is the most suitable and accurate for the valuation of startups, especially when compared to other commonly used methods, such as the multiple methods or the venture capital method. We talk about the need to correct the risk associated with the startup, with the use of the specific data which takes into account not only the market risk, but also qualitative risk that derives from the development phase and the uncertainties of a startup. We have also seen how to apply the startup investment readiness scores to further adjust the total beta based on a structured and objective assessment of the factors that influence the success of a startup. In addition, we discuss the importance of calculating the equity value and the fact that the enterprise value must be properly distributed between debt and equity in order to obtain an accurate assessment of the value of the part of the company that the investor will buy. In conclusion, an accurate valuation is essential for making informed choices, both for investors and entrepreneurs. And by using the discounted cash flow method and adjusting for specific risk, we can achieve a more accurate and consistent valuation, which truly reflects the value of a startup. See you next week!